September 22nd, 2025. A date that will be remembered not for wars or elections, but for something far more intimate. The moment every shopping bill, every business transaction, every economic decision in India was quietly transformed. They called it GST 2.0, but perhaps a better name would be the Great Simplification. After nearly a decade of wrestling with tax complexity, India decided to rewrite the rules of commerce itself. Imagine walking into a store where the price tags no longer confuse you, where the tax isn't a puzzle to solve but a simple fact to accept. For 8 years, Indians had navigated the maze of 5%, 12%, 18%, and 28% tax slabs, each purchase requiring mental mathematics just to understand the final cost. But complexity, it turns out, was never the goal. It was merely the price of transition. The architects of GST 2.0 had a vision radical in its simplicity. Two core rates that could govern most of economic life. 5% for the essentials, the things that touch every household. Soap that cleans your children. Toothpaste for morning rituals. Packaged food that feeds your family. 18% for everything else. The standard rhythm of commerce, predictable as a heartbeat. But simplicity demanded sacrifice somewhere else. Enter the 40% rate. Not just a tax but a statement of values. Pan masala that stains teeth. Aerated drinks that promise nothing but sugar. Luxury yachts that float on inequality. Private aircrafts that soar above public need. If you want to consume what society considers harmful or excessive, you'll pay the price of that choice. The morning after GST 2.0 launched, something remarkable happened in stores across India. Maximum retail prices began changing overnight. Not through government mandate but through market forces. Dabur's real juice dropped from 130 to 122 rupees. Amul Paneer fell from 99 to 95. Companies weren't pocketing the savings. They were passing them on, as if prosperity had become contagious. For the middle-class family saving for their first air conditioner, for the small business owner finally buying that dishwasher, relief came in the form of mathematics made simple. Consumer durables that once carried the burden of 28% tax, large televisions, home appliances, the tools of modern comfort, suddenly became 18% more affordable. The aspirational became achievable. But perhaps the most profound change touched something deeper than shopping. It touched security itself. Life insurance premiums, once taxed at 18%, became completely exempt. Health insurance, the shield against medical bankruptcy, joined the sanctuary of zero taxation. In a country where one illness can destroy a lifetime of savings, this wasn't just tax policy. This was social policy disguised as revenue reform. Yet here lies a fascinating paradox that reveals the sophistication of this reform. Why keep some life-saving medicines at 5% instead of making them completely free of tax? The answer lies in the invisible mechanics of business. When something becomes completely tax-exempt, manufacturers lose their ability to claim input tax credits, often making the final price higher than if it carried a small tax burden. Sometimes a little tax creates more affordability than no tax at all. Behind every simplified rate lies a complex web of business consequences that most consumers never see. The dreaded inverted duty structure, where raw materials were taxed higher than finished goods, had been choking small manufacturers for years, especially in textiles. Imagine trying to run a business where your inputs cost more in taxes than your outputs earned. GST 2.0 promised to end this mathematical nightmare. But complexity has a way of hiding in the details, and the transition to exemption created its own bureaucratic puzzle. Companies whose products suddenly became tax-exempt faced a cruel accounting exercise. They had to reverse all the tax credits they had claimed on stock still sitting in their warehouses. It's like being asked to unpay taxes you'd already legally claimed, calculated at prevailing market prices and certified by chartered accountants. For service providers, the new world required surgical precision in their accounting systems. A hotel could now offer rooms at 5% tax but premium catering at 18%. Their accounting software had to learn to split, allocate, and calculate proportional credits with mathematical precision. Simplification for consumers meant sophistication for businesses. The ripple effects reached into the physical movement of goods across India's vast landscape. Commercial vehicles, the trucks and buses that form the circulatory system of the economy, saw their tax burden drop from 28 to 18%. Lower logistics cost didn't just mean cheaper transportation. They meant companies could rethink their entire supply chain strategies, moving from fragmented local warehouses to efficient regional hubs. But there is one demand that remains unfulfilled: a dedicated GST dispute settlement authority. As the system grows more complex, disputes would multiply, and general courts aren't equipped to handle specialized tax conflicts. Today, as GST 2.0 creates new complexities even as it resolves old ones, that institutional gap looms larger. Looking beyond India's borders, this reform places the country among the ranks of nations that have chosen simplicity over complexity in taxation. New Zealand operates with a single 15% rate. Australia uses a flat 10% with specific exemptions. India's two-rate system positions it between these minimal models and the complex multi-slab systems of Europe, where standard VAT rates often exceed 20%. The global comparison reveals India's unique challenge: balancing the revenue needs of a developing economy with the consumer welfare demands of a democracy. European nations can afford complex systems because their administrative machinery is more sophisticated. India chose simplification not as a luxury but as a necessity. The term Bachat Utsav, the savings festival, wasn't just marketing rhetoric. It represented a philosophical shift in how India views taxation. Not as a burden to be maximized, but as a tool to be optimized. Not as punishment for economic activity, but as partnership in economic growth. The festival metaphor suggests celebration, community, shared benefit. Yet questions linger in the spaces between tax slabs. Will the 40% rate on luxury goods genuinely discourage consumption or merely create a parallel economy of avoidance? Will business adapt to the new compliance requirements or struggle under the weight of technical complexity masked as simplification? Will the missing dispute resolution mechanism become a bottleneck as the system matures? The deeper story of GST 2.0 isn't really about tax rates. It's about trust. Trust that simplification will deliver on its promises. Trust that businesses will pass savings to consumers rather than pocket them as profits. Trust that the government will resist the temptation to complicate what has been simplified. Trust that complexity reduced in one area won't simply migrate to another. As Indians wake up to this new tax reality, they are not just experiencing lower prices on soap and insurance. They are witnessing an experiment in economic democracy. The idea that tax policy should serve people rather than perplex them. Whether GST 2.0 succeeds will be measured not in revenue collections or compliance statistics, but in something more fundamental: whether the everyday act of buying and selling becomes a little less burdensome, a little more transparent, a little more human. In the end, the greatest tax reform isn't about the rates we pay. It's about the trust we build in the system that collects them. That's all for today on UPSCwise. If you found this video helpful, hit like, share your thoughts in the comments, and don't forget to grab the PDF notes on my Telegram, link in the description. Keep learning, keep growing, and keep moving closer to your IAS dream. Jai Hind.